The Bank of England declared there was good news at last in the battle against inflation. But interest rates continued to tick up again today for the 14th time in a row, up to 5.25%. Rates are at their highest level since 2008, with critics complaining the medicine is becoming worse than the disease.
I'm much more confident that inflation is now on the way down and will go down markedly this year and into next year. And that's important for households. I think it's important that they can plan with confidence, thinking it's on the way down.
Cause for celebration for the Prime Minister, who had promised to halve inflation by the end of the year. The bank's forecast today gifted him that victory. But not everything is on target.
You were right, I was wrong.
Growth at the back end of next year is expected to be just 0.05% on a knife's edge to recession. Business investment is also falling next year, all thanks to a squeeze of higher interest rates, now expected to average 5.5% over 3 years.
Well, the rate rise that we've seen today is just another hammer blow to families across the country who are seeing their mortgages increase when it comes to remortgaging.
In Leeds, the Tucker family are making all kinds of cuts to their spending because of a lethal mix of higher inflation and also higher interest rates.
The kids ask about swimming and why we don't go to the gym anymore, which is a bit of a shame. It's the small things. It's sad that we can't do that anymore.
But the biggest strain has been mortgage payments, with the Tuckers' home loan deal expiring at the end of June.
Every time the Bank of England declared another increase and then another increase and another increase, and I've been watching this for the last year, knowing full well that our mortgage deal was going to come to an end.
Millions of households like the Tuckers have rolled off fixed-term mortgage deals signed in the heyday of benign interest rates and now face eye-watering increases in their housing costs. The Tuckers had to redo their loan with Halifax, which meant switching rates twice.
When our fixed rate ended, they transferred us to a standard variable rate, which is huge. It's 8.49%. And this has increased our mortgage payment, which we had to do in July, by £800. We can't afford that.
Following this interview, Halifax refunded the August payment. Kirsty has now secured a fixed rate of 4.24% with Halifax. But even with the fresh deal, the Tuckers are paying an extra £4,000 a year because of the sharp increases in interest rates.
I was in floods of tears actually on the phone to them. It's completely, last month wiped out any savings that we had.
But the bank says the price of tackling inflation is worth paying, with hopes the economic shocks of the last 3 years are finally fading into the distance.
Some of these very big shocks that we've been experiencing in the last 2 years are now working their way through, and we're seeing the sort of, in a sense, the back of them at this point. So that's good.
But people at home might be baffled by the idea that we're seeing the back of them. We talked to a family in Leeds that has to come up with an extra £4,000 for those people at the sharp end. Yes, it doesn't sound like the back end of the crisis.
I understand the difficulty of that, but I think it's very important that inflation does come down. If it doesn't, then it gets worse, and that's I'm afraid the really honest message to give.
But you said there's several paths, but more or less it's the same thing. Over 3 years, there's an average of 5.5% for interest rates. That's higher than bank rates are even today. For households and for businesses, that means a lot more pain to come.
What would it take to bring interest rates down from here? Because I think that's a question that I think households obviously would like to know the answer to. Now, I think what it would take from here is that people become much more confident about the path of inflation going down. They see the evidence, which I think they will see. I think we're beginning to see it now, and I think they will see it. They become much more confident about that. They build it into their expectations. Price-setting firms build it into their expectations. People feel much more confident about wage negotiation building it in. And that will create a good dynamic going down, and I think that's the thing that would really begin to unlock the idea that interest rates can come down.
What the governor is saying is that if on the horizon inflation looks like it's coming down, people will stop asking for higher wages, prices will calm down, and if that happens, interest rates won't have to be so punitive. But we're not there yet.
We are seeing, frankly, a level of increase in wages, which is not consistent with the 2% target. Now,
is that the spiral? Is that the spiral?
I wouldn't use the word spiral, not least because I think we are on the downside with inflation now. But let me say this. I understand why people are taking this view on wage negotiations because of where inflation is. What I would say is I think we are now much more solidly in territory where inflation's coming down. We're going to see it happening through the rest of this year. And I understand people say, well, that's all well. I want to see it, I want to experience it, I want to feel it and have the benefit of it. But I think it's important that we now start to build that in, we start to demonstrate it, and then it can get built into people's expectations and how they go about life, as it were.
The bank's policy of relentless hikes may have delivered the government's political objective of halving inflation. But for people at the sharp end, the pain is undeniable. And even some within the bank warn that rates have gone too far, causing too much damage.
Well, after the bank's rate decision was announced, I went to speak to the Chancellor, Jeremy Hunt. Chancellor, you say if we follow the plan, inflation will come down. Let's be clear about what the plan is. It involves people being poorer, doesn't it? Below inflation, real terms pay cuts, people not being able to afford their housing, parents not being able to afford their supermarket bills.
Well, that is what happens when inflation gets too high. It eats away at the value of the pound in every single person's pocket, and that's what leads to the industrial relations problems, the strikes, because people are angry about the fact that their pay is not increasing by as much as inflation. The solution is to get inflation down. That means interest rate rises, which is what we've had today. But what is encouraging...
And pain for ordinary people.
Of course, there is pain when there are difficult decisions. But what is encouraging is that if you look at what the Bank of England are saying today, they can see an end to that pain because they can say, according to their own forecast, that in a year's time, inflation will be down to 2.8%, so within spitting distance of their target of 2%. And when they get close to their target, that's when they can start to reduce interest rates. So you get the benefit of not just inflation being back where it needs to be, but interest rates coming down as well.
But there's a big lag, isn't there? I mean, it's clear that interest rates are going to stay high for longer than we previously thought. And that means that even though inflation may be down this time next year, people will be struggling with mortgages and rents that they can't afford. I mean, and you're going to be going into election around that time asking people to thank you for it.
Well, I will be going to an election saying to people that we have done what it took to bring down inflation. And what the Bank of England governor said today is that we are bringing it down solidly and consistently, and that is very, very important. But what we want to do is not just that. We want to help people through this difficult period, so we're giving the support of around £3,000 to the average household this year and
not
next.
as much as in America, for example, or in the Eurozone, where they did things like massive subsidies for transport. In America, the Inflation Reduction Act, huge amounts of public investment. That's what, in America, has enabled them to bring down inflation without the risk of recession. You know, and people are looking at it and saying, well, what are we getting?
Well, I disagree. I think giving over £3,000 of support this year and last compares extremely favourably to the support that the US government or European governments have given to their populations. It's very, very generous, around £100 billion of support to help people through this very difficult period.
Then why are we not doing as well as them in terms of bringing down inflation?
Because we have a combination of factors which they don't have. So we have higher dependence on gas, which is what countries like Italy have. We import around half our food, which is what Germany does. And we have very low unemployment, a tight labour market, which is what happens in America. We've got all of those factors.
And Brexit was a big factor in some of that, weren't they? Certainly in terms of the labour market.
Well, we've had low unemployment since long before Brexit. It's actually been a strong feature of our economy. But what it does mean...
But you're not saying Brexit hasn't been a factor in inflation,
I think you need to look at the figures. I mean, you always try and persuade me that Brexit has been a factor, but you need to look at the numbers here. The fact is that it's to do with those factors. It's to do with the high energy prices, the food imports, the tight labour markets. Now, if you look at America, if you look at Europe, they have done the same things that we're now doing. So if we follow the course we're on, if we stick to the plan, we can get inflation right down. And that's what today's numbers show.
The big controversy this week, as you know, has been about oil and gas drilling and your government's now commitment to hundreds of new licences. When there was a proposal to drill for gas in your constituency, you cited the push for net zero, the environmental damage as reasons why it was bad. How can you now support drilling in the North Sea? If environment is a big factor in Surrey, why not in the North Sea?
Because these are totally different situations. As a constituency MP, I do my job and stand up for constituents who are worried about environmental impact. But when it comes to the North Sea, something very profound and important has changed in the last 18 months, which is that we've realised that what matters is not just the transition to net zero, but also energy security. And it happens to be a lot more carbon intensive to import gas than to use our own supplies.
But we won't have access to our own supplies, as you know. They get sold on the international market. There's no reason why we will definitely get North Sea oil and gas.
Well, we're far more likely to get them if we're extracting that gas than if we're not extracting it. And the extent to which we do that reduces the carbon footprint of the gas we're using. But over time, we are going to be reducing the amount of gas we use. That's what transition is about. But we need to be responsible and work out what is the least damaging way to use fossil fuels in that period of time when we're winding down their use.
Chancellor, thank you very much.
Thank you.